Everyone wants to talk about deal structure, creative terms, how cheap can I buy the business? But what you really need to be focusing on first is getting the financial statements. That is where the real truth lies. And in this video today, I'm going to show you exactly how you can read between the lines. So let's get into it. All right, so tip number one, reading between the lines in financial statements. So if you ask for the most recent financial statement, and let's say it's August 2025, and they give you 2024 financials as their most recent financial statements, red flag. That should be a good indication that their back office is a mess, their reporting is lagging, and they're very unstructured, but it could also mean a big opportunity for you. So if you think about timely financial statements, it may sound something insignificant, right? It's not. It's a representation of how your entire business is operating, all the way from generating sales and creating that order, no matter what your business model is, through that entire order to cash life cycle. When the revenue actually gets recorded in your financial statements, that represents that whole order to cash life cycle. That represents how smooth your business is operating. And if you're producing financial statements from 8 months ago just now, that's a problem, because what gets tracked gets managed, and you can't be a profitable entity without managing your financials. You just can't. Even if you are, let's say you have crazy margins, right? That is not sustainable. You need to be managing your performance monthly. So not getting financial statements that are recent, at most it should be 2 months of a lag when you're asking for financial statements from a business that you're buying. If it's further than that, that's a great indication that there's some back office problem. Tip number 2 is mid-month reporting. So a lot of times when you're asking for financial statements, the owner or whoever is in charge of their back office will go and print the financial statements and go, here you go. And a lot of times, this is silly, but a lot of times the default reporting date range is today's date in financial systems like QuickBooks. Well, what will happen is you'll say, hey, can I have your most recent financials? They'll say, sure, no problem, print. And you're gonna get something that says year to date through August 15th. Well, you have an incomplete month. So if you're trying to do a year-to-date analysis, you pretty much have to throw it out and start over, because you have this incomplete month that could be creating this wildly inflated profit that doesn't exist because you haven't finished the month, right? So you need to get completed financial statements through whatever period that is. If that's through, July, or if that's through, May, whatever that period is, it needs to be complete. The other challenge you get is when they're giving you financial statements and maybe it's a small business owner and they don't understand that the balance sheet and the profit and loss statement are connected, right? You need to get both for the same matching period. And a lot of times they'll print off that August year to date profit and loss statement, and then they'll hand you a balance sheet from May, right? So those two are wildly different, and you can't really do an appropriate analysis unless you have matching period statements. So if you're going to send July balance sheet, you need to have July profit and loss statement. Tip number 3, which is my personal favorite, add back games. So when you're buying a business, a lot of times it's done off of an EBITDA valuation. So what does that mean? Okay, so earnings before interest, taxes, depreciation, and amortization. That's what EBITDA stands for. Let's say you are buying a company that is producing $1 million of EBITDA. Well, if you're buying it of a multiple of 4, you're buying it for $4 million. Simple math, right? 1 million times 4. Easy. Well, a lot of companies have add backs. So what they'll do is they'll take their underlying financial performance and they're going to add back adjustments for things that shouldn't be there. It should represent expenses that are being incurred that are not part of the regular operation. For example, a business owner buys a personal car that has nothing to do with the business, but they're writing it off, right? Or Another example would be they have family members on payroll that are not actually doing anything. They're not showing up to do a job, but they're being paid. Yes, this does happen, and it happens a lot. In case the IRS is watching, I'm not doing that, so don't come after me, all right? The one common game I see played when doing add backs is, I want to say probably 90% of the time, the owner is going to add back their own salary. So what does that tell you? That is the owner making a statement basically saying that, hey, I'm irrelevant to this business. This business operates without me. It's almost like I'm the family member on payroll that doesn't do anything, right? And that's not the case the majority of the time. The owner is the captain of the ship. A lot of times the owner is the one driving the business forward. Sometimes they are the business, right? And I still see them try to add back their salary. What that says is basically, hey, you can take over this business right now, eliminate my salary, and be perfectly fine. Well, that's not the case. And that's the number one thing that I argue on add backs is I have to either A, go hire someone to replace that owner, or B, step into that role myself. Either way, we can't be adding back, right? And if you think about it, let's say the owner's paying themselves $200,000 a year. Well, it's not just $200,000 a year that you're paying as part of that purchase price. It's times 4. Let that math sink in. So you need to fight for every single add back because it's increasing your purchase price by a multiple of 4 for every single thing that's being added. All right, so last tip for this video, the balance sheet never lies. It's in the name, the balance sheet must balance, right? The profit and loss statement and the balance sheet, they're both financial statements that are connected. So if they're just sending you a profit and loss statement, you could be looking at a business that's generating $1 million of profit a year. However, the balance sheet is what tells the real story. So the balance sheet may indicate that they're having a massive cash flow problem, which is why is that important to you? Because you may have to purchase the business and on day one, in addition to the purchase price, inject several $1 million of equity into the business. Does that sound like something you want to do? You need to know what you're stepping into. And looking at the profit and loss statement is a very incomplete picture of their overall business. I would argue that the balance sheet is a better indication of how their business is running than their profit and loss statement. All right, so before you get cute with doing all your sort of creative structure and deal terms and all that cool fun stuff, right? You need to focus on the financial statements to even tell you if it's even worth pursuing. So if you got value add today, do me a favor, like and subscribe, and I will see you next time.